Good afternoon. It's Jeffrey Christian of CPM Group. It's about 12:50 in the afternoon here in New York on Friday, the 5th of December. There's a lot of ground I want to cover today. I want to focus on realities, but there's a lot of misinformation that has been blowing up, not only in the precious metals market, but throughout society right now. And I think that's always the case, but sometimes it's worse than other times. And I think we've seen this week, at least, a stepping up of the willingness to lie to people. Let's call it what it is. It's a lot. Could be disinformation, could be misinformation. People might not know what they're talking about. People might consciously be trying to mislead people. I don't really want to focus on that stuff. I want to focus on what's really going on. And in doing so, hopefully, I'll be able to dispel some of those issues that have been being circulated. I'll end this presentation with two things. First is I'll talk about a few of the misrepresentations. There's a silly rumor, nonsensical really, that JP Morgan has moved all of its precious metal staff to Singapore. I'll talk about that at the end. I want to have a few comments on the genius stablecoins. A bill has been passed by Congress and signed into law by the administration that is going to create a stablecoin, and it has a lot of risks, not only for investors, but really for the world. And I have a few comments on artificial intelligence and the errors that are present in what AI is spewing out and the costs to the world of those errors. But let's focus on the real market. These are the gold price. The gold price right now, it's actually flat from yesterday. It's at $4,243 for the February COMEX futures contract. It was up about $28, $30 earlier today. Then it was off about $10 or so. It's bouncing around. It continues to be volatile, and you're seeing upward pressure. CPM Group has written for its clients in the trade recommendations and other reports over the course of the week that this period of consolidation that really started in the second half of October appears to be ending, and prices may well break out to the upside. We are a little bit cautious about that because we can see, the ability of the prices to move downward very sharply. But we think that as December progresses, we will become more convinced that the consolidation is over and that when prices move more consistently in one direction, it will be upward. That will reflect investment demand. Central bank purchases through October of this year. We had 24 central banks that were net buyers in the first 10 months of this year. We only have data for People's Bank of China through September. Everybody else is through October, including Russia. 24 central banks is about the number that we've seen. We've basically seen 18 to 26 central banks as gross buyers in any given year over the last several years. Collectively, they bought about 8.4 million ounces. There are about 7 central banks that were net sellers this year through October, and they've sold about 1.2 million ounces. So the net balance of central bank purchases has been about 7.2 million ounces. It hasn't been 20 million ounces. It hasn't been 30 million ounces. It hasn't been 34 million ounces. In fact, it hasn't been 34 million ounces in a long time. The most recent peak was actually back in 2013, and that was 25 million ounces. Over the last 3 or 4 years, we've seen central banks buying 10 million ounces, 15 million ounces, 8 million ounces, and this year they're on pace for about another 8 million ounces. All right. So central banks are buying. They're buying less at higher prices. but they are continuing to diversify their portfolios, their monetary reserves away from currencies by adding gold. And the increased value of the gold that they already own, about 1.2 billion ounces, has gone up sharply in value and as a percentage of their monetary reserves as a result of the price increase. Looking at silver prices, they have risen very sharply. I mean, gold rose $150 in 5 trading days at the end of November into this Monday, December 1st, and then it came off. Silver rose $10 in the same 5 trading days. That's a 20% increase. It's very important to understand because insofar as a lot of bullion banks lend silver out to miners, refiners, smelters, fabricators, and other groups that want to borrow silver rather than buy it outright. If they're charging 3% interest rates on those leases, they're getting 20% more at $58 an ounce on Monday than they were at $48 the previous Monday. Now, the price has come off. It's trading around $59. Actually, it's at a new record today. But bullion banks are having record years in terms of their profits because of the high prices. $59, I've said it before, I'll say it now again. Anything that goes up $10 in 5 days can come off $10 in 5 days. We don't expect that. We wouldn't be surprised to see the price fall back. $52, $53 is some support. $50 is some technical support. $48 is some technical support. We saw $46 2 weeks ago. So we have to be a little bit careful about short-term declines. But again, longer term, the silver market looks poised to increase in price over the next couple of years. Looking at deliveries, because there's been a lot of attention paid to it, December is an active delivery month for gold, silver, and palladium and copper on the COMEX. And last week we had the Thanksgiving holiday, which was closed the COMEX on Thursday and had a abbreviated session on Friday. That kind of made the market a little bit more hesitant going into the delivery period because you had New York closed while London and other international silver, gold, copper, and palladium markets were open. But we have seen in the last 2 trading days of November when the December contract was deliverable, and so far this week through yesterday, we don't have data for today yet, we saw 50.975, 50,975,000 ounces of COMEX futures contracts, December contracts, delivered. It's not necessarily that the metal has gone away. I'll show you some numbers in a second. But 50 million ounces. Now, I've highlighted in here actively traded contract months over the last 2 years. And you can see 29 million ounces in March of last year, 83 million ounces in March of this year, 78 million ounces of silver in May, 50 million ounces in July, 71 in September. October was interesting because it's not an traditionally actively traded contract month, but we saw 40 million ounces. That reflected the flow of silver back out of the New York market, back to London, from whence it had come in previous years. I'll show you a chart in a minute and you can see that. So the 50 million ounces, pretty much in line with past delivery periods. And it's very important to understand this. These represent deliveries of contracts. A lot of times the metal stays there. I'll show you a chart, a table with the COMEX deliveries, inventories, and changes in inventories in a second, and you can see that the metal, 82 million ounces of COMEX contracts were delivered in March of this year. Inventories didn't necessarily change 82 million ounces, and it's a key thing that people have to understand. These are the actual inventories, and you can see just looking at March, going February, at the end of February, we had 408 million ounces of silver reported into the COMEX depositories. It got up to 475 million ounces. So there was a big delivery into the COMEX depositories, not necessarily out of it. And you can see that of that stuff, only about 20 million ounces were in the registered inventories. The bulk of it went into eligible but not registered inventories. You can see the changes, the table on the right, are the monthly changes over the course of the month. And so you can see 52 million ounces in February, already high, big increase in a non-traditional delivery month, but heading into the traditional March trading month. And then another 66 million ounces in March. You can see how inventories started at the end of January of this year. They were 355.8 million ounces. They got up to 530 million ounces at the end of September. They came off sharply in October, 47.8 million ounces. Much of that going over to London, where the unallocated silver inventories had dropped low, opening up a price arbitrage whereby you could buy in New York and profitably ship it, the silver, to London, with the profits so high that in some cases people were actually flying the silver instead of sending it by ship, which is the traditional way to ship silver back and forth across the Atlantic. We saw another 25.7 million ounces delivered in November, much of that in those last 2 days, trading days, and decline in November, much of that in those last 2 trading days. Again, continuing to represent that arbitrage opportunity to buy silver in New York and ship it to London. Year to date through yesterday, we had about 448,000 ounce increase in COMEX depository holdings. Now, of the amount, you can see at the end of October, registered inventories were 164 million ounces. They declined to about 138 million ounces at the end of November. And as of December 4th, they're slightly higher, 46,000, 47,000 ounces higher than they were at the end of last month, i.e. at the end of last week. And you can see also that eligible but unregistered metal actually has increased about 400,000 ounces. So big deposit deliveries of COMEX contracts, not big changes, at least so far, in inventories. That's not to say that more metal won't come out and be shipped to London or other places. Most of the delivery notices tend to occur at the start of the month. So these are the contract deliveries over the last 6 days, the first 6 delivery days of the COMEX December contract. And you can see 7,000 contracts representing 36.7 million ounces on the first delivery day. This is when people who are short a contract, the contract, notify the COMEX clearinghouse, hey, I have silver, I've given you the depository receipts, I'm delivering against my contracts that I'm short December, I'm delivering that silver. That's the issuance of a delivery notice by a short. The COMEX clearinghouse then notifies along in the December contract, hey, we had these deliveries, these contracts that have been delivered against December short positions. you are the proud owner of this because you're long December. And then a lot of those guys will then redeliver it the next day. So you'll see that metal turn. You'll see the deliveries, the same metal be delivered at least twice in most cases. And that's why the amount of silver in the depository doesn't necessarily change in line with the delivery notices. And again, through the first 6 days, 50.97 million ounces of delivery notices. Not a big deal. No big crisis here. This isn't silver that's going off to being used in solar panels. This is silver that's being traded back and forth. A few other things I wanted to clarify about silver. There's no backwardation in silver prices. You can see here the prices I had on Wednesday. I calculated at one point. There's about 91 cent contango or positive forward carry between the December and the March COMEX contracts. That represented about 1.56%, which annualized to about 6.2, 6.3% annualized return on that position. Today, this morning, earlier when I was preparing these slides, the price of silver for December was $58. As I said, let's see, right now it's $59.23. December was $58. March was $58.85. That was an 80-cent difference. That was 1.4%, which annualized to about 5.5, 5.6%. That's a really good return. It's definitely competitive with Treasury interest rate, and you're locking it in, which is very important. I'm buying my shorts back in my December shorts back. I'm selling them short in March. I'm locking in 1.56% profit, which annualizes the 6% return. That's a pretty good locked in profit for that. There's some other things that I do to make that even more attractive. So there's no backwardation in the COMEX. Some people sometimes use that term to refer to the difference between New York prices and London prices. That spread, the New York-London spread, is not a contango or a backwardation. A contango and a backwardation refers to forward spreads within a given market. Right? So there's no backwardation. And people will say, oh, yes, there's a backwardation in silver that represents a tightness in physical markets. Well, sometimes a backwardation does represent a tight physical market, and a contango or a positive forward spread reflects ample supplies, right? But if there's no backwardation, there's no indication that it could reflect tight physical supplies, and there's no backwardation. London inventories are rebuilding. Again, we saw a big decline 2021, 2022, and then we saw a further decline in 2024 into the first quarter of this year, when inventories in London, reported inventories in London fell from 850 million ounces down to about 713 million ounces. They have recovered through October. We don't have the November figures yet. In the end of October, they were 790 plus million ounces. So they've sort of recovered that. And this is metal that's flowing back and forth. This is metal that when it came out of London last year, it went into COMEX inventories. It didn't go into solar panels or missiles or other things. And now that the spread between London and New York is reversed, it's going back to London. Some other silver market realities. The first delivery metal moved from the registered to the eligible. That's not surprising given the arbitrage between New York and London. We haven't seen a lot of that metal come out yet this month and be shipped to London, but it may well happen. London is getting much better supplied, so there's less of a pressure there. Also, the roll into the March futures contract provides handsome profits, as I just discussed. There were comments about JP Morgan moving a lot of metal in from registered to eligible. That was metal stored in JP Morgan's depositories in New York. And that's a depository business. People pay JP Morgan money to hold their silver and gold for them. It's not necessarily JP Morgan's metal. Some of it may be. Most of it probably isn't. JP Morgan provides that depository services and charges for them. If you look at the issues and stops, the issuance of delivery notices and the taking of delivery, you'll see that JP Morgan is like, one day earlier this week, 570 issues of delivery notices and 470 issues of taking notices of taking delivery. Why would a bank do that? Because it's not doing that. These are services that they are providing their clients. And some of the clients are issuing delivery notices, and some of the clients are taking delivery. It's not JP Morgan doing it. It's JP Morgan servicing its clients. And insofar as some people don't understand that, it's sad. Insofar as some people understand it but continue to misrepresent what it is, that's even more sad and more worrisome. Right? Also, moving the metal out of registered to eligible reduces the storage costs. And when you're locking in a 1.6% profit over the next 3 months, and you can shave a few cents per ounce off of your delivery, or off of your depository storage fees, by you continue to pay your depository storage fees, but you don't have any charges with COMEX that you've registered that stuff. There's no clearinghouse fees that you're paying. You save some more, and you increase the profit of having bought back your shorts in December and sold short in March. There is an arbitrage between London and New York and London. That's reflecting the movement of physical metal. That's being reflected in the movement of metal out of New York back to London over the last 2 months. May continue. Another thing we heard was that the CFTC had authorized banks to rehypothecate silver allocated to ETFs. First thing is that the CFTC doesn't have the authority to do that. And the second thing is it didn't do that. Sorry, it just didn't do that. Somebody told you a lie. Turning to platinum. Platinum prices have been very strong. They continue to be strong. Right now, they're up about $5 from yesterday, but they're $1,665. That's a very high price given the fact that from 2015 to 2025, till June of this year, prices basically traded between $800 and $1,100 an ounce. So we've seen this breakout in prices, and it largely reflects investment demand and investor concerns over supply and demand. There is no massive multi-year supply deficit. That's what marketeers want you to believe. The platinum market basically is a surplus market. It has been in all but about 8 years since we started collecting data in 1976. We started collecting data in 1979, but we took it back to 1976. It tends to be a surplus market, but the surpluses, which got very large going into about 2020, have come down and have contracted quite a bit over the last 3 years. So the market is tighter in that the amount of metal flowing into the market from refineries, either from mine production or from scrap recovery, is much closer to the amount that fabricators want. And that has been reflected in the higher prices. You have a tighter market. but it's not a massive multi-year deficit. Critical for the platinum demand is the commercial vehicle markets. These are larger vehicles, trucks and buses, delivery vehicles, often diesel powered, because diesel power gives you more power than petroleum, gasoline, petrol, or electric vehicles. And so these vehicles tend to be diesel powered. They tend to use platinum. They're much more important for the platinum market. And we've seen, the U.S. market for commercial vehicles has contracted the last 2 years. It's off more than 10% through October of this year. Europe has been off about 7 or 8% last year and again this year. Japan was off more than 10% last year. It sprung back a little bit. And China, which was off about 3 or 4% last year, is doing better, but there are government programs that are encouraging corporations to buy commercial vehicles this year. Those benefits go away next year. So you're taking 2026 demand for commercial vehicles forward into 2025. But the commercial vehicle market has been weak for a couple years and continues to be weak. And if we go into an economic recession or slower growth period in 2026 in most markets, which is the consensus view right now, you can expect that to continue to be weak, and that could reduce demand for platinum even more. And you could see those shrinking surpluses expand again next year. But there are also supply issues that we're paying attention to right now. More supply concerns than actual reductions, although there have been some reductions and there will continue to be more reductions in mine production next year. Palladium prices also have risen very sharply. They're up again today. We have the same concerns about palladium that we have for platinum. These are industrial metals more than financial assets. They do follow gold and silver higher. It's very important to understand when you're looking at the palladium price, investors have added 377,000 ounces to their palladium ETFs so far this year through October. Okay, so much of the growth in demand for palladium, physical palladium, has been from investors as opposed to fabricators. Going back to those other things that warrant clarification. Again, JP Morgan did not move its precious metals trading operation suddenly to Singapore. There were rumors to that effect that came out early this week, and they just were not accurate. There's this thing called the Genius stablecoins. It's a legislation that the Trump administration has been pushing. Congress approved it, and they've signed it into law. It probably will start being rolled out late next year, according to the Treasury. It's a way of backing crypto stablecoins with U.S. dollars. It has a lot of risks for investors and for the financial system. It's not private. It's totally exposed. Not only can the government see what you've got, but other people can see what you've got. And it also takes away a lot of protections. There's no FDIC insurance. If you have your money in a bank up to something like $250,000, you have FDIC insurance against a problem at that bank. Stablecoins will not have FDIC insurance. They'll not have a lot of other protections. They can be depegged to the dollar, apparently very easily. They are more vulnerable to runs and liquidity issues, and they could also cause liquidity issues in the dollar market too. And they're capable, they're much more easily used in illicit financial transactions, money laundering, uh, financing drug movements and armament movements and human trafficking and other things. So there's a lot of negatives to genius stablecoins, and it warrants a lot of consideration. We think they'll be very good for gold and silver because as investors realize that what this is it's weakening the guardrails in the US dollar financial system. I would think that more and more people will say, hey, um, I think I want to get out of that and put more of my wealth in gold and silver. Finally, as I said earlier, there's this explosion of misinformation, disinformation, and inaccurate information and outright lies. And artificial intelligence is adding to that. I've talked to a couple people I know who are working with one of the most respectable software developers heavily involved in artificial intelligence. And they said their internal tests show an 80% error rate. And I can see that in tests that we've done. If you go and look up, did JP Morgan move its precious metals desk to Singapore? You won't find JP Morgan saying, no, we didn't. You won't find any legitimate news entity saying they did, but you'll find reports that they did. Got it wrong about Gus Winkler. Gus Winkler is an interesting guy. He grew up in the same neighborhood I grew up in, but he was born maybe 60 years earlier than me. He may have known my grandfather. My grandfather was an explosive expert. He comes from a multi-generation, I come from a multi-generation family of explosive experts. And he may have known my grandmother because after my grandfather passed away in an explosion accident, my grandmother during Prohibition turned to bootlegging and selling her wine that she made to Al Capone's gang. And Gus Winkler worked for Al Capone. He was one of the non-Italians. Al Capone called them the American boys. That was part of that gang. And Gus is notorious because he was the guy who was most readily identified as being one of the gunmen in the Valentine's Day massacre. But if you look at AI, you won't find out any of that. So AI just adds to the risks that we're facing in a world that is facing a lot of problems, and our ability to deal effectively with those problems is being dealt a blow by misinformation and disinformation, outright lies, and just not knowing what's going on. Now, on Monday, the 25th of December, CPM Group will work with Silvercorp and have an online webinar, The Gold and Silver Renaissance. We talked about a golden renaissance starting in October 31st, 2000. We released the 2000-year gold survey that we produced. And we said that you would see an upward shift in the investment demand curve, first for gold, and then it would be investment demand, by investors buying more gold at higher prices for a longer period of time in more parts of the world than ever before in history. And that after several years, central banks would join in and silver would join in too. And that in fact happened. Gold bottomed out in 2001, silver bottomed out around 2005. Central banks shifted from being net sellers of gold to net buyers of gold around 2008. You've seen this golden renaissance and silver renaissance go for a quarter of a century now. Not 1 or 2 years, which is what a bull market used to be in the 1960s, 70s, 80s, and 90s and aughties, but up till the aughties. 25 years of a bull market in gold and silver. And we don't think we're anywhere near the end of that bull market. Secular upward shift in the investment demand curve. It's investment demand that's been driving gold prices higher and silver prices higher. Fabricators did not come in on Thanksgiving week and say, let's drive the silver price up $10. Investors came in and said, I think silver is going to rise. I'm going to buy. And lo and behold, as they bought, the price rose. But we don't think we're at the end of this renaissance. We think that governments and politicians around the world are working very hard to convince investors that they should have more of their money and wealth in gold and silver. And this is going to continue for a long, long time. On Monday, the 25th, Lon Shaver of Silver Corp will join me in a webinar to discuss where we've been, how we got here, where we are today, and what we think we're going to see in the next quarter century. You can register at the link here to participate in that webinar. That's all I have for now. This is a long one, but there's a lot of ground to cover. I hope it was useful for you. You can go to our website. You can buy our yearbooks. You can buy the Precious Metals Advisory. The December issue came out yesterday, the 4th of December. You will have noticed that several of the charts and some of the data that I showed you here came from the December Precious Metals Advisory. You can send us a note at info@cpmgroup.com and say, let's talk about how CPM Group can help me make more intelligent investment decisions. That's all I have for now. We'll be back next week. In the meantime, take care of yourself, take care of those around you, do something good for the world, and have a good read.